All right, we had a little bit of a disruption from the prior couple of weeks where the market just hasn't been moving very much at all. But today it definitely moved. It moved in the wrong direction, probably for a lot of us, of what we want it to do. Coming down and producing some signals today that, again, knowing we have, earnings announcement tonight after the market closes. We have jobs numbers tomorrow morning before the market opens. We have the election result potentially starting at least next Wednesday morning, potentially for that Wednesday morning, most likely later, and then the FOMC on Thursday. So we have a lot on the plate. If we didn't have all this on the plate, we'd be looking at these signals today as the potential start of a new intermediate move. So I'll talk about what those signals are, obviously which direction that move would be. And we'll take a look at that. In today's video, a lot of interesting patterns, a lot of setups. We'll talk about how do we look at these signals, knowing that there's so many unknowns within the next so many days. So we'll break all that down, take a look at what's driving the action today specifically, what's moving the markets. There was one sector really that was the biggest loser today that dragged pretty much everything else down with it. But the problem is that that's a very notable sector. We'll talk about which one and why it's very notable today. And then we'll take a look at our trade idea, which is in another kind of cyclical area that itself has been showing some bearish signals. A little bit further along than what the S&P is, but showing some bearish signals going forward. And we'll talk about that and how to make a trade on that for these next few weeks. So let's go ahead and get started. Today is Thursday, October 31st, 2024. My name is David Settle. This is the Market Outlook from MarketScholars.com. Hey, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're following us on our blog, check out some of these other things over here on the right, including our Market Outlook live trade. This is where I take a look at old trades, see whether we should stay in them or get out of them. We got out of a few of them today in there, some old trades we've done in prior videos. We also put on today's trade already before the market closed there. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that, scroll down and click on today's Market Outlook. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see a pretty down day today for the S&P, dropping going into the Apple and Amazon earnings tonight. Dropping down, producing a bearish short-term pattern. The momentum line dropping to extreme lows. The near-term line dropping easily into the reversal zone. The intermediate line having already crossed the market sentiment line. Remember, without the bearish near-term low, now does have that bearish near-term low. Still in bullish territory, but dropping. So clearly a bearish pattern. What typically would be considered the beginning stages. Like you had a bull tag for most of the day, but we dropped so much by the end of the day that it actually turned the moving average line lower. And so now that's why we don't have the actual bull tag. Here, obviously you can see it stayed yellow on the day that we crossed below it. Here we crossed below it, it's turned red. It's already down. And that's mainly a function of just how sideways we had been for the last couple of weeks. It was already flattening it out versus over here by the time we dropped, we had just started to drop for like a week to get to the moving average, and that's why it was still rising at that time. So, but essentially that's a bull tag. So you get your bull tag on a day that you have pretty bearish short-term sentiment and the intermediate line crossing already below market sentiment line. It would be one thing if market sentiment was like down here. It's another when it's when we're so far up to the upside. So that's it's obviously the main reason why it dropped so much is because of the Nasdaq, which also produced a bull tag, a little bit deeper of a bull tag than what we saw even over here when it was barely crossing below, but similar to the 1.2% decline. We're at 1.16, so similar to that bull tag. You can see all these other ones, like we're only a 0.5% below there when we bounced. We were only a half or a quarter of a percent below it there, a third of a percent below when it bounced there. So a little bit more of a decline. Once you start getting deeper on the bull tags, the harder it is to immediately bounce back. Not that it can't, because obviously, especially with earnings tonight, that's going to really impact the NASDAQ 100 way more than any of the other indexes. In fact, it's already bouncing a little bit. The Qs are already up a little bit, up over almost $1 in the after hours, mainly because of Amazon. Apple down just a little bit. So, but this is the main reason why we're producing the bearish signal on the S&P. Now, the Dow, remember, was already more bearish than the S&P. It actually is in intermediate decline now. The dark pink shading in a red line, the intermediate line in bearish territory, already well below the market sentiment, already had its bull tag. We've already, built on that bull tag by going to the downside. The short-term sentiment is very bearish, way down here to the extreme levels on the near-term line. This will not be as impacted by the earnings, but a little bit. If you recall, the Amazon did join the Dow earlier this year, but towards the beginning of the year. So it will impact the Dow a little bit. Remember, the Dow is a price-weighted average. So if we were to look at the actual index, so it's not market cap weighted like the S&P 500 is. So instead of sorting it by its market cap, or Apple, Amazon, Apple, Microsoft are at the top, 3 of the Mag 7, you have to sort it by the price, and Amazon is not at the top. It's like in the middle. Below Apple. Apple actually has a bigger weighting in the Dow than Amazon does. So Amazon won't have nearly the impact on the Dow. It'll have some, depending upon what everything else is. You can see some of these others. Microsoft actually has a bigger impact, and being down 6% today obviously does not help when one of its bigger components falls the most. So that's kind of what's going on with kind of this after hours action. If you look at the Russell 2000, it also it's got the signs of intermediate decline. It's got the dark pink shading and the red line. It actually has it with the crossover, so it's kind of rare to get. We did not get a bull tag here because we're below 50. If we had been above, if it was light pink shading, if the intermediate line was still above 50, then you get it. If you see the moving average already moving lower, if it was still moving slightly higher, then you would have had another bull tag today. But again, like the S&P, you got the red line, and then like the Dow, you've got the dark pink shading already. Now you're not below 40 like the Dow, but you're working your way down there. Hence the dark shading here. Bearish short-term sentiment coming off of what you probably can qualify now as a bearish peak. You did get above 80, but barely, and you're only there for a day. You really were only in bullish territory for a few days. So pretty bearish peak now. Looking back, we crossed back below the intermediate line yesterday, and then now into oversold levels today following the momentum line. In fact, yesterday was day one of the near-term line falling out of bullish territory below 60. So day two, if it's going to be a bearish low, day two has got to get below 20, and it did, right? And the momentum line being extremely low suggests that the near-term line probably will stay kind of like this. When the momentum line is so extremely low, the near-term line usually has a hard time rallying the next day, so it usually ends up following down. So it most likely will even get further into the reversal zone tomorrow, even if we're only up, unless we completely reverse this. If we're up a little bit, it most likely will still continue to move lower to the downside. Let's take a look at the weekly chart, and you can see the reversal, the transition candle on the S&P. Still don't have that red arrow yet, but you do on the NASDAQ 100, right? Remember, that's the sign, that's the reversal sign here. The Dow Jones Industrial Average, remember, got that last week. At least the transition candle last week, that was a bearish candle. Now it has a red arrow this week with a pretty bearish candle there. And then your Russell 2000, you can see again, red arrow as that PPO is rolling over from pretty high levels compared to the past few years. Obviously, you have 3 red arrows now across the board on all 4 indexes. The first day for the S&P and the NASDAQ. It's been multiple days for the Dow already. And then the Russell, this is the first day again, right? So you had a few days before. This is day 4 out of 6. And this is day 4 out of 5 for the Dow Jones. And 1 of 1 for the S&P and the Qs. Again, usually that's a very bullish sign. But this, like it was in early September for the S&P, is a little bit more for the Qs, and eventually bounce back up. We need to bounce right back up here pretty quickly. And considering the earnings tonight, and considering, and you can see we're up a little bit here, and considering the jobs report tomorrow, we could bounce back up pretty quickly here if we get a positive market reaction. Otherwise, we're going into tomorrow's employment report with bearish signals, like they are signaling today, like not just bearish signs across the board, but like they're actually signaling today. Like 3 red arrows, is a signal. Now, again, it's either a bounce signal to a really good new move to the upside, or it's the beginning of a bearish move. It's one or the other. It's not like every day is up or down. No, this is an inflection point. An inflection point between 2 pretty decent sized moves, either the beginning of a new intermediate decline or the resumption of the bullish trend with a new decent sized leg to the upside. So, again, crossing our fingers, in this case, it's the latter and not the former. Looking at some of the other oscillators, they're not necessarily working in our favor. The DMI has a bearish crossover there. You're almost above 30 on the negative indicator. You are below 20 on the positive. The Qs, you can see, show similar signs, or you're not quite below 20 on the positive indicator. The same thing with the Dow. You're already below on the positive. Now the negative is crossed up above 25, and then your Russell 2000, you can see there's kind of crossing over each other right around 25 with a very, very weak trend. All setting up for a trending move to develop, and starting off at least with a pointing in the negative direction, a direction we don't really want to see. Looking at your RSI and CCI, we're still okay, right? Again, we've had this before. We dipped down below 200 on the CCI, and we almost got below 40 back on September the 6th when we rebounded. This one's a little different. Like, we haven't been below minus 300 in a while. Like, you have to go back, well, we haven't been in 5 years, right? This is the lowest level in 5 years that we've had on the CCI. You have to go back even further. The last time we were minus 300 on the CCI, and we actually did drop below 30 on the RSI, was back over here on August the 5th of 2019. Remember, that was right before we got the rate cuts 2019 that helped stave off any potential weakness there. Obviously not going to get a rate cut next week, so it's a little concerning there. Now, we didn't drop below 30 or even below 40 like we did on August in 2019, but still, that's a bearish sign to be down that low on the CCI. Just kind of goes to show just how significant of a shift in bearish sentiment it is. It's kind of hard to really rebound from this and go, like, say, right back up above 150, which would help signal a reversal here. Looking at the Ichimoku cloud, we're still above the cloud, but we lost our trend. Like, when you have a mature trend and it goes to 0, that usually is a sign that we're starting an intermediate decline. And here we go. I mean, it's one thing to go to 0 when you've had kind of a weak bullish move. You can kind of bounce right out of it. But it's another thing when you've had a mature trend, in this case above 5 and above 80 down here, then once they both go to 0, again, generally speaking, it's a sign that the trend is changing. It doesn't have to mean like we're going in a correction like 2022, but it's changing at the very least into an intermediate decline or a pullback towards the 200-day moving average would be the idea. So like I said, we're not just seeing bearish signs out there. Like, we're actually getting signals today, like the actual signals themselves on a lot of these indicators coming to the Bollinger Bands. We did not cross below the lower band, nor the lower Keltner channel. That would have been the signal here, but and we'll see if that ends up happening. But we did drop into the lowest quartile. The bands themselves move back inside the Keltner channel as the momentum appears to be shifting from positive to potentially negative. So that's something to keep an eye on tomorrow. Again, tomorrow's news, the jobs number, could throw all this technical analysis out the window, because that's how it works, right? But based off of what we know, right? Based off of, because the market kind of has an idea of what the jobs number will be based off the ADP numbers and everything else that it takes into account. People, pay people a lot of money. They have departments that help try to figure out, to guess what and be able to price in what that number is and what the market reaction, so that they can gauge what the market reaction will be. Unless it's completely out of nowhere, the market is going into tonight's earnings, because this is before the market close, and it's going into tomorrow's jobs numbers with a bearish, kind of a little bit of a bearish breakout. Not significant. We didn't break below both of these levels, but a bearish breakout nonetheless, according to a lot of these other charts I just showed you. So again, now if something comes out of nowhere tomorrow and the market loves it, then they can throw all that out the window. But if the market kind of gets what it had been kind of expecting, then you can kind of see the direction the market wants to take going into an even more important events next week with the election, of course, and then the FOMC meeting on Thursday. Obviously, they're going to cut rates, one more time. Sorry, I said before they're going to hike rates. Cutting rates, right? They are going to cut rates this time. Cutting rates one more time. They are going to cut this time. There's no question, no debate. You can debate whether they should cut or not, but that doesn't matter, right? Nobody really cares what we all think about what the Fed should do. What the Fed cares about is, obviously their stated goals, but also the Fed cares about what the market thinks they're going to do, right? Because this Fed in particular, does not like to shock the markets. So they will prep the markets, and then they will follow through with what they've been prepping the markets for. The markets have been prepped for a rate cut at this meeting. So unless we hear Nick Timros writing an article sometime next week about the prospects that the Fed might not cut, then the market is prepped for that cut. It's priced it in completely. The bond market, the futures market, obviously now the stock market. So a change there would be very out of character for Powell. So we're going to get the cut. That's not a debate. The debate will be, and they will start prepping the markets for the expected path. They had been prepping the market for an extended cut cycle going into next year. We'll know tomorrow. We won't get their projections tomorrow, or next week, that will be in December. But they'll start prepping. They start to say, okay, maybe we'll start to back off that cut cycle and kind of gear it back towards maybe like what they did in 2019, was just a few cuts, 3 in particular, and then be done with it. Similar to 1995. It wasn't back to back to back in 95, but they ended up only cutting 3 times there. And so, that wasn't the case in September when they came out with their projections. They projected a full cut cycle of 200 basis point, 225 split evenly actually between those two. And now we'll see if they start to walk that back and how the market responds to that. Again, we're going into that with everything that the market can know about these events next week and the jobs number tomorrow, with these kind of bearish signals. So we can kind of take them with a grain of salt, because these big unknown events that are very market moving are coming up within the next week, starting with tomorrow morning. But we can not completely dismiss them, because this is the market's take based off of all the information it has going into those events. This is what the market feels like, right? And it's produced. It has been producing a nothing burger for a couple of weeks, and now it's producing some breakout signals, right? Some initial bearish intermediate decline signals based off what I've just shown you here. If you look at, we did not get a break to a new 4-week low, but we did finish right at the lows of the day, bouncing up a little bit, like I said, in the after hours, thanks to Amazon and Intel for that matter as well. But finishing at the lows, a big drop right into the close on this, starting to fill in this gap that we had from August the 8th, right? That kind of runaway gap that we had there. This is definitely a runaway gap now. So now, can we fill it? Yes, nothing's 100%. But the likelihood of us filling is lower, because we gapped down with a significant amount, gapping into the lower half of the 4-week range, and then we ran away from the open, and then close at the lows, being down almost 2%, down 1.96%. I mean, that is classic runaway gap. Runaway gaps and breakaway gaps are the two gaps that we don't fill in. sooner rather than later. We might fill in this case, we will fill that in. The market will go back up at some point in time, and whether it's next week or whether it's a year from now, it depends on whether or not we are just getting a pullback, whether or not it's going to turn into a correction, or if it's going to turn into a bear market. We don't know, right? Obviously, bear market is very, very low odds. But that gap will get filled in. Even if it turns into a bear market and we don't see 577 for another 2 years or 3 years or, however many years, it took from 2003 to 2007, 2000 to 2007 before we retouched those 2000 highs. So it took 7 years there. But we will touch those. We will fill that gap in, right? So, but it will be later rather than sooner versus your typical common gaps that are filled in sooner rather than later. And I do not think that's a common gap at all. I think that's a runaway gap. Runaway gaps occur at the beginning of trending moves, and considering all these other beginning signals that we've been getting of a bearish intermediate decline, this fits that bill, right? That we're potentially starting day one of that decline here with that gap. It's still a very narrow range. We did not get a new 4-week low point, though we are set up for it, right? We hit 0 already on the red line. We're well below 70. We're below 50 on the green line. So we're set up for a breakup to the upside, right? They don't have to be very long, but that's what your intermediate declines do. So we're close. We're close to that happening. The Dow Jones Industrial Average did get that. So you see, we did get that break. I mean, this is a typical sign. Now, it can be a one-touch, and this happened to be a very short pullback here. And that's what we'd really be rooting for right now is a one-touch. But if it stays up here, if we get a new low tomorrow, then now we got to wait for the green line to hit 0 and the red line to drop to below 70 before we get a bounce, right? A breakup to the upside. So that's the Dow Jones. IWM, you can see, did not get a new 4-week low point nor a 4-week high point, and we won't, right? It's a little bit further away. And then, of course, your Qs. The Qs are similar, a very similar pattern. But all of them, even if they're not producing 4-week lows, are breaking below last week's lows. And that's significant because we had that last week. We broke below the week before's lows, but then we rebounded pretty quickly. So we really, the Qs looks a little easier. SPY, we'd have to rebound quite a bit to get back above last week's lows by the end of this week and close, like we did here. So we did end up getting back up above these lows, just barely, but we got right up and just a little bit above those lows by the end of the week, or right here actually, by the end of the week. So, and we were clearly up above it, early on Friday before falling to the end, but at least we closed either right at the lows or maybe a smidge below it. That's not the case here. We have to really rebound tomorrow to get back above yesterday. So that's a bearish sign when you've got a lower high point on the week and a lower low point on the week, and as of right now are literally closing at the low. That won't be the case tomorrow, unless we have another down day and we close at the low tomorrow. But we're not going to close at 568.55 tomorrow, most likely. Let's take a look at today's range and volumes, right? So when you look at the range here, you can see it was 7 points, but remember we have to keep in the gap. So 580 is the close. The high is 575.63. So about 4.5 points. We have to add on about 4.5 points there. So you're looking at over 11 points range. That's the biggest range we've had in a long time. And that's really jumped. So you can see the ATR has really jumped higher. The volume pulled up a little bit. You can see, go back to this chart and see the volume. But above average. We didn't get to that black arrow, which you typically get when you have these declines. See, we didn't quite get there on that bull tag either. But if you look at, if I were to go back a year, you look at some of these declines here. They're above average when we start, and usually at least you get the black arrows by the end. We came close there. We did get them here at the end of this pullback. But when it definitely is above average, for sure above average there, and actually did came a lot closer on this one than we did on any of these other red arrows in terms of getting to that black arrow right on the first day of its decline. But obviously these numbers rising is not bullish. If we get back above 100% or 1%, excuse me, if you get back above 1% on this normalized ATR, that's when intermediate declines, right? That's what happens during intermediate declines. And we're not quite there yet, but you can see how close we are. And then finally looking at the VIX jumped today, not surprisingly, but it had jumped yesterday and closed above 20 yesterday. But man, it really jumped today up to 23. The VVIX is up to 121. You can see the VIX versus the VIX 3Ms above 100%. Remember, it hardly ever got above 100% during an actual correction in 2022. This is the second time it's been above 100% this year on just typical pullbacks. So the VIX is definitely behaving differently than it did during that weak correction of 2022 there. But you can see it well above its averages. I mean, the VIX is trending higher. All of its average values are trending higher. The VIX is trending higher, and considering that VVIX is so high, it's set to make a big move, right? So this is not a big move. We've seen big moves on the VIX. This is not a big one of those big spikes, right? We get these spikes when the VVIX is already at 110. So you get the smaller moves before you get the big spikes. I mean, zoom out so you can see more big spikes on the VIX, right? So these are the big spikes. They don't come out of nowhere, but you can see you tend to get these smaller moves on the VIX before that spike comes. In this case, in Thanksgiving of 2021, you had about a 7% gain right there in the VIX before that. It really pales in comparison to a 54% gain, but you get the idea. Well, we had a 13% gain. I mean, that's not huge. That's not a VIX spike. You have to get above like this, 30% is kind of what we marked here, 30% level to really get, I mean, again, the last one being here on September the 3rd, and to kind of put that in context of what the VIX looks like when it gets those spikes, there September the 3rd, right? That's a bigger move. And the VVIX this is not that big of a move. But the VVIX is set up for that move to occur, right? So when you look at the VVIX, when it's above this 110, so there's September 3rd. It wasn't above 110 there. It was sitting right at looks like under 100. But over here you can see it got above 110, and then you got the spike. Here you're above 110 easily at 121. So we're set up for something worse. Obviously, you have a lot of event risk in the next week. Again, election results, which the market really won't care too much about who wins or who doesn't win. The market goes up with no matter who the president is. The Cape ratio rallied with Biden and Trump. So the market doesn't care about that. The market just cares that there actually is a result. And the biggest question mark there would be that we don't get one all week long next week, and the market won't like that. If there's any shenanigans, right, or legal issues, like we saw in 2000 with the election that lasts, then you could really have, and the market's valuations, remember, are very high. So the markets right now is not set up for that kind of issue, right, that kind of question. It really wants, to maintain such a high valuation, it needs a result as soon as possible, a clear result that everybody accepts as soon as possible. So that's why your VIX is so high, and then you have the FOMC. Could they start walking back that rate cut cycle? I don't think the market would initially take that to be, that would create some volatility initially. Ultimately, it would be the best case scenario for 2025. If the Fed's not cutting rates in 2025, that means that we're having a bullish market. So that would be the best thing for 2025. But initially, as the market, starts to price those cuts out, it would create some volatility before setting us up on a good move to the upside. So that's all on the table in the next few days, including, again, this jobs number, which there are some estimates of the jobs number being barely positive, if not even maybe a little negative. Now, granted, probably won't be because of everything that we've seen, but we had such a big number last time that was mostly fueled by an increase in government jobs. So how will that be revised, and what will this one look like? And people kind of start to read between the lines and aren't necessarily accepting of just the headline number. So that's all going to be taken into account pretty quickly here in the half hour before, hour before the market opens once that jobs number is released. All right, so I spent quite a bit of time on those charts and talked a lot about what's driving the action today on those. But let's kind of briefly go through some of these charts, including how things performed here today among these different asset classes. So we'll go to just today alone here to see the movement into, interestingly enough, not necessarily all safety trades, as commodities finished the day higher. Now bonds also finished the day higher, so yields a little bit lower. Bonds started the day, yield started higher, but bonds rallied as you can see the Qs were down 2% almost all day long. IWM finished down, big late drop on both SPY and IWM, getting down to that almost 2% mark on SPY. Interestingly enough, international equities rebounded at the same time that the U.S. equities were declining. Bonds rebounded. The dollar was relatively flat, but pretty much everything down, including gold, gold and real estate, to traditional safety trades. They were also down today. So kind of an interesting pattern. Again, looking at the 10-year yield, you can see ended up being up 2 basis points today, almost 2 basis points, up to 4.28%. Again, flirting with 4.34% for the second time in 3 days. We got to 4.34 2 days ago, and then we got to 4.333 today. But you can kind of see some signs of exhaustion. I mean, not necessarily reversal signs, but signs of exhaustion for this momentum gain that it's had. So even if it does keep going up, it's probably not going to go up at the pace. Definitely won't go up at the pace that we've seen here over the last little bit. If you look at TLT here, let's go to this chart here, and let's go to a rate of change for TLT, because that's would be the inverse of yields, right? And so if we were to go rate of change, it's been, well, let's go to the low point. The low point was right here, and that was a 31 bar, so a 30. We'll do a 30-day rate of change on this. Ultimately, looks like ultimately this was end up being the low point of about 9%. If I were to zoom out for some context on that, it's a pretty decent sized move. It's not the biggest drop in TLT or the biggest rise in yields, but it's kind of up there. You can see some of the other bigger ones, especially during the rate hiking cycle that the Fed had in 2022. Remember, we're in a rate cutting cycle right now, so usually we're not supposed to get this kind of move. And we had one at the end of last year during that intermediate decline that was a quasi correction on the S&P, and then of course in early 2021 we had a big drop before bond yields started to fall and TLT really rose. So it's a pretty decent sized move. Again, not extreme, but it's right up there with some of the bigger declines that we've seen. So you're probably not going to drop obviously you're most likely not going to drop with the same pace that we've had. You're going to start to really slow down. The question will be now what commodities will do, because commodities had a pretty decent rebound yesterday and followed up today, getting back above the 17-day moving average. The MACD turning up, stochastics turning up. So if these start to turn higher, it will be hard for yields to fall if commodities are rising. So that's a really important relationship. It's typically a positive relationship between yields. So it doesn't mean yields have to go up, but it will definitely slow any fall that yields could have if commodity prices continue to rise and the dollar continues to remain strong, right? So let's see here. It is a dollar sign before that. Oops. Sorry, is it? Not a dollar sign? Yeah, there we go. So there's your dollar. It's already showing some of that weakness, and that's, this would be great. Ideally, commodities would fall too, but this would be really good for yields. But you notice it's not like trend changing. Like we're not starting an intermediate decline on the dollar. It's still on a pretty decently strong intermediate bullish rally to the upside. You just have a bearish. I mean, this would be a intermediate confirmation signal, right? An oversold momentum line combined with the overbought. In fact, we've had 3 days of this intermediate confirmation signal, and now your near-term line's in bearish territory, right? It's below 20. It's not too extreme, but it's below 20. But this would be this is a bit of a buy the dip type signal. So we'll see if we end up buying the dip. We're pretty far up above, so we're not going to like bounce up, crazy like like over here. We're not going to get that kind of move. Again, similar to yields. You don't. If it goes up, they won't go up a lot. But if this bounces off this trade, which you would expect that it will, because that's kind of what this technical pattern suggests that it will, then that means yields probably won't go down. And if commodities continue to rise, they really won't go down. Again, they're not going to go off like crazy like they did have. But as long as they stay pointed higher, obviously we've seen that puts pressure on equities, because right now that's the correlation, right? The correlation between the yields and equity prices. Sorry, let's go. I need to put the CGI on. There we go. So the yields is negative. It's back to kind of a normal, it's inflationary, or excuse me, it's deflationary relationship where yields and equities have a negative correlation with each other. Inflationary relationship. Bonds and bond prices in stocks have a positive correlation. Yields in stocks have a negative correlation. So we're back to an inflationary relationship that we've had for the last couple of years. You can see here over the past few years. You can see that's been the relationship, whereas traditionally, here's the past few years. Traditionally, if I were to zoom out even more, it's more positive relationship between yields, and it's been a recent phenomenon that it's been so negative, and you can see it really clearly when I zoom out to a 3-month correlation. Here you can see positive, sometimes negative, but very brief, not very much. Now the positive moves are brief and not very much, and we've been on a positive move, and as we've seen on the shorter time frame, it appears to be petering out. That positive move appears to be petering out as the 2-week correlation is really down again. There's the positive move, what it looks like on that 63, that positive move on the 63. This is what it looks like here on the 10-day, and now we're obviously down. So again, yields moving higher would put pressure on risk appetite in general, and we're seeing that. Like I've told you before, that some of the important ratios to watch are, again, especially how XLK is doing, because XLK is a big driver. It's got Apple, it's got Microsoft, it's got Nvidia, as well as Intel and AMD and a lot of other chip companies, but it's got Apple, Microsoft, and Nvidia in it. Those are the 3 biggest companies in the S&P. We go as they go, especially Nvidia, but we go as they go, and you can see the big drop XLK has had, well below its 17-day moving average, dropping below its 50-day at the ratio of the XLK relative to SPY, breaking below its 50, and you can see the rotation is moving, in the wrong direction. XLC moved up thanks to Google, and semi thanks to Meta, but mainly Google. But XLK is moving in the wrong direction. XLY has been moving up, and so those two have been looking okay, but it doesn't, again, on a long-term basis, that hasn't been necessarily the case, as they've been showing some signs of improvement, but they're still in the wrong, right? You still have other areas that have higher momentum, and definitely have other areas, these interest rate sensitive areas, that have the best relative strength over the last little bit. But we'll see if that rotation, right? That rotation here, breaking, like I said, breaking the 50, already below the 200, and breaking below all these other moving averages. Are we going to continue down? Is it going to be like September 6th, where we kind of bounce back up? We were a lot lower there, so we could bounce back up. We're a lot higher now, and we're set up. We haven't even broken down yet on a lot of these oscillators. We're just going negative on the PPO. The long-term PPO may be rolling over. Like we haven't crossed over yet on the DMI, so this may just kind of be getting started. And another sign that another ratio we look at in kind of conjunction with that is the Qs relative to IWM, and had been relatively bullish, but breaking below its 17-day as things kind of roll over. And of course, we also like to look at, from a consumer standpoint, discretionary relative to staples. And it had been so bullish, even up until just like yesterday, but getting up to these old highs at about 2.5 on the ratio, and again, not dropping below 17. That's a pretty clear reversal of 4 days worth of move to the downside. So we'll see if this is strongly positively correlated with the S&P. Hopefully this is just a one-time thing, and we don't follow through on this through the 17-day and potentially the 30 tomorrow, post jobs report heading into the election. The breadth is still pretty negative, but not as bad as you would think on a day like today. You can see the new lows index flirting with that 72 number. Let's see if this will be updated. if it has been updated yet. The new lows is at 69. So is that what we saw there on that chart? Yeah, so this has been updated, 69. The new highs wasn't too bad either, finishing down at 88. But again, on a day like today, you would think it would be a much lower, but still well below its average, below 100. But the new lows, that's a little bit of a jump up. So pretty close to getting the Hindenburg omen signal, right? That 72 is the sign. We've all month long, we've pretty much been at 2 on here, but we've never had, this is the first day that the new lows kind of took off. So it's a little bit different today in that regard. So we might, kind of another sign that we might be kind of starting some weakness as this ratio is really taken off. The number of stocks above the 50-day moving average has really dropped well below 250. And hasn't dropped below 200 yet, which is, again, sign of weakness, but definitely below the 50% mark. Again, that's a stark drop from when we were just barely above 400, above the 80% mark, just a couple of weeks ago when I left. And looking at the number of stocks above the 200, again, below the 70% mark at 350 and working its way lower. And, you can see pretty much most of the year we've been well above 50%. But we've also been above 60% and even, at 325, the 65% mark. But we'll see if that, how, we flirted with it during this pullback, and we'll see how, if we end up getting some weakness there, just for some perspective on what it looks like when we do break that level. As you saw, I don't know why that didn't do, let's try this again. There we go. So as you saw last fall, when we had that big pullback, we did drop below 50% pretty easy. And obviously during the correction you did during 2018. So when you drop below 50, it's pretty significant on a correction level. But getting below its average, that's pullback levels, right? Especially getting back below, say, that 325 mark, which, again, 300 would be 60%, 350 would be 70%. So right in the middle at 65 is that 325 mark. Getting back below that is a sign, especially when you've been above it, a sign that we are on a weak move to the downside. Obviously, the advancers is still well below 50%, at that low level on the breadth thrust, and then the bullish percent index getting below its average. Again, another sign of weakness. If that ends up playing out by tomorrow, this is a weekly chart, so it'd have to play out there by tomorrow. But definitely breaking below 70, which is a bearish sign on. This is the percent of stocks in the S&P that are showing bullish patterns on their point and figure charts that stock charts puts together this index here. Finally, let's look at the sector moves today. So we'll go to the sector comparison chart, and you'll see October 31st. 5-minute chart, you can see again safety, utilities, and staples outperforming. Healthcare, communication services are doing well again because of earnings. Energy doing well. Again, that's not necessarily what we want. We don't want energy to outperform, but XLK was your big loser. It was the only sector to underperform the S&P, down 3%, and that's not what we want. It's very hard for the S&P to be able to maintain a bullish trend if XLK is continuously underperforming it. So hopefully this is just a one-day thing, and Amazon and Apple are able to rebound tomorrow, and we're able to get that going back up to the upside. As I mentioned, Amazon's had a good reaction so far. Apple a little negative so far. So we'll see. And again, jobs numbers could change things in a drastic way. But going into jobs, and again the election and the FOMC of next week, with everything that the market currently can know about those events and what they could possibly be, this is the market reaction so far going into all of that. And again, like I said, going into even tonight to the earnings announcements that we saw tonight. All right, that brings us to our trade idea of the day. You can see one of the sectors that underperformed, obviously not the markets, but most every other sector was materials, XLB there. And you can, if I were to take a look at FCX today, take a look at the chart for FCX. You can see it had a bull tag last week. We were kind of hovering until yesterday. We broke down, and then today we really kind of solidified to the point where the intermediate line is crossed below market sentiment, and it's crossing the bearish territory with some very bearish, strong short-term sentiment. and you have a dark pink shading and a red line already on there. You have a bearish candle on the weekly chart after a transition last week, and a red arrow. You're actually trading, if you look at the regular candle, below the 40-week exponential moving average. Not necessarily the best sign for that. You'll see that again here in just a second. We've had 3 red arrows for a while. Now we have a red line to go with those 3 red arrows. So that's not the best sign either for the stock. You're looking at this chart. We have also broken below the 50 and the 200 day. That's the big change today that we didn't have yesterday. You're still in the value area, but you're below the point of control. So now the low end is going to be kind of a gravity pull as you're moving away, especially below moving averages. Remember, you get your biggest moves both to the upside and the downside when you're below moving averages. You have a bearish crossover on the DMI, though both lines are still above 25. Again, kind of rare to get both lines above 25 when your ADX is so low. But it is a bearish crossover nonetheless when you have both those lines up as high as they are. Looking at the RSI and the CCI, not surprising to see a bearish sign here, below 150 down there, below 40 here. Looking at the Ichimoku cloud and the trend strength indicators, you can see we have a intermediate strength trend developed here, pretty much at 2 on the trend quality, and you're above 65 on the noise balance. So that's your level. You're below the cloud now. At least you will be tomorrow, barring a big jump to the upside. The green line is crossed below the blue. Your rate of change has clearly gone negative on this. And we are clearly in the lowest quartile of the Bollinger Band width, right? And not breaking the lower band, not breaking the lower Keltner channel, but definitely pushing against it with some pretty decent bearish momentum and green dots. So the bands themselves now have moved outside. So they're setting up for a trending move, right? That's what happens when your bands move outside. So with that said, I said, okay, well, if we're going to get a potential trending move out of this, let's sell the low 20 delta. In this case, in December, we'll sell that low 20 delta, buy 2 strikes away for protection, and position size like we normally do for half $500, half our normal, normally for like iron condors and short put verticals, we put about $1,000 at risk, or 1% of a $100,000 allocation. In this case, doing $500. So because it's a directional trade, we don't put as much at risk. It's lower probability. We closed out a few directional trades that we had in prior Market Outlook videos. We did that in the Market Outlook live today. So we ended up, instead of losing $500, we only lose a couple $100 on those, which is the ideal scenario. When you take losers, you want your losers to be small, because when you get big, winners, they're going to be bigger, right? And we'll see if this ends up being the case. We have some flexibility in case, it is bearish short-term sentiment. So if short-term sentiment starts to rebound a little bit, we have some flexibility on timing. It doesn't have to move right now. Even though we do need it to move sooner rather than later, it doesn't have to move immediately for us to get what we need to out of this trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your night, everybody. Have a happy Halloween, and we'll see you all in November.